Hey guys, welcome back to another First Budget Friday. If you've been around here for a while, you know that Val and I have been documenting our journey towards debt freedom here on YouTube for quite some time. And recently we've begun trying to share a bit more of our journey, a bit of the lessons learned, to try to help people from stepping in maybe some of the same pitfalls we have. And that's what the First Budget Friday series is all about. It's advice that I wish I would have had and taken at a much younger age than I am currently, that hopefully you will have available to you and you will take while you're much younger than I am now, to hopefully set yourself up for a better future than you may be headed for, financially speaking. So today we want to talk about how to safely build credit, because everyone says you need to build your credit. Everyone says you need to do all these things to build your credit, but no one really says why or how to do it without getting yourself into trouble.
All right, so the first thing we want to cover is, what is a credit score?
Yes, in short, a credit score is a numerical representation of how risky you are as a borrower. So the higher your score is, the lower risk you represent to the banks or financial institutions or whatever that you would potentially be borrowing from, which is good, because usually when you have a higher score, you can get better rates on things. There are certain things where if you don't have a sufficient score, you just can't even do them. And a lower score is obviously, you represent a higher risk to the banks of that, so they'll be less likely to offer you the good rates, offer you the good loans, offer you the lower payments, or offer you anything altogether.
Yeah. So in Canada, the scores range from 300 up to 800, with the average Canadian rating right around 650.
Yeah, so babe, now that we know what a credit score is, what do you need it for? Who uses it?
So you would be surprised. When most people say credit score, they think the obvious things, like if you're going to apply for a mortgage, a personal loan, a credit card, and most banks and creditors, in fact all of them, I believe, unless you're paying for a secured credit card, are going to pull your credit, look at your score, and determine your rates from there. That score that you rank on is going to determine how much they're going to loan you, if anything at all, and how much interest you're going to pay based on your risk. But there's some other things that use other companies that will use your credit score that you might not be aware of. I don't know if it's the same everywhere in the world, but I know specifically here in Canada, your credit score will affect things like getting an apartment.
Yeah.
Not so much what you're going to pay for rent, obviously, but whether or not they'll approve you. If you have a low credit score, there's a lot of places now that will not rent to you because you're considered a high risk.
Yeah, because you got to think, one of the things folded in, and we'll cover this more later, but one of the things included in your credit score is how up-to-date you are in your payments and how diligent you are in paying things, which is something that a rental company would want to know, because even though you're not borrowing financial money from them, you're still borrowing in the sense that they are giving you a space versus someone else who maybe would be more likely to pay.
Yeah. Another thing is utility companies. Again, specifically here, when we opened up our power account, for power, they pull your credit, and if your credit rating isn't high enough or good enough, they will make you pay a $300 deposit just in case you default on your payments. Then they have that financial security from you up front to cover your shortfalls. Other things that your credit score can affect are your insurance rates.
Yeah.
So if you apply for tenants insurance, car insurance, life insurance, they will pull your credit to see what your risk level is, and if you're a high risk borrower, which sounds weird because you're not borrowing life insurance, you pay for it, but they will charge you a higher rate for that.
Yeah, for sure.
There's also some banks that will not let you open a bank account with them, particularly credit unions. This
really surprised me and upset me by just the absurdity of it. Like, I was legitimately mad at this place. Still am. I'm not going to throw them under the bus because I'm not like that usually. Yeah. Mostly I'm like that. This time I will not be like that. But we went in, everything looked good. We wanted to start
open a checking account.
We wanted to open a checking account with them, and they ran through all the paperwork and applied, and then they were like, you can't bank with us because your credit's not good enough. Like, I need to have good credit to have a fancy shoebox to put my money in.
Which is funny because the same bank had loaned us the money for our car loan that we had at that time.
Yeah.
So we already did business with them. In fact, they had loaned us money, but they wouldn't let us open a bank account. So it's really weird the way in which your credit score can affect you. But there's even some employers here that will run your credit before they hire you. Not common, I don't believe so, but I've had a
Yeah.
couple employers who have in the past. It's quite strange.
Yeah, it makes no sense to me. Like, what do you care how up to date I am on my payments? You're giving me money, not taking money from me.
Yeah. So while I agree that the credit score is not so important in terms of getting you loans and stuff, because I don't believe that anybody should be taking out loans for anything other than maybe like a mortgage, it affects a range of other things. So no matter how much you want to avoid it, your credit score is important.
Yes.
So how is it calculated?
So, pardon. So 35% of your credit score is based on payment history. Do you have a good track record of paying things in full and on time? You know, are you behind at all? And if you are, how far behind are you? 30% is based on how much you owe, also known as
Credit utilization.
How much could you conceivably take if you wanted to max everything out versus how much you actually have?
Yeah.
It's the idea of like what do you owe on your credit cards? Do you have a $10,000 limit where you owe $3,000? That's going to look a lot better to creditors than a $10,000 limit where you owe $10,000.
Exactly.
Or worse, a $10,000 limit where you owe $11,000.
Exactly. Creditors will look at that to see if you're overextending yourself or not.
Yeah.
15% is your length of history with your credit accounts. So how long have you had these accounts open for? Are you opening up a bunch of new accounts and then closing them and opening up new ones? The longer history you have on an account, the better your score will be.
How long is your history and what does it look like? Like Val says, if over the last 10 years you've opened and closed 100 accounts, that doesn't look as good as someone who for the last 10 years has been diligent with the same 3 accounts.
Exactly.
Or, loans or whatever. Let's see, and 10% is based on the types of accounts you have. So personal loans, lines of credit, credit card, vehicle loans, student loans, secured credit cards potentially.
Lenders like to see a little bit of variety. Like it's good if your credit report can show on-time payments for like a cell phone bill, and then secured credit, which would be something like a car loan, and then unsecured or revolving credit, which could be a credit card or a personal line of credit.
And then the last 10% is based on your recent activity. So, have you been applying for a bunch of different loans or credit cards or whatever? And kind of the reason they look at this is because if you're applying for a lot of loans in a very short period of time, it could potentially indicate financial trouble. Yes. Like you're trying to borrow a bunch of money before it impacts your credit score for whatever life situation has happened, but it could potentially indicate that you'd be unable to pay that money back, which obviously they would not like.
This is essentially every time a creditor pulls your credit. So if you're applying for a car loan and you go to one dealership and they pull your credit and you didn't get approved, and then you go to another dealership and they pull your credit and you didn't get approved, and then you go to another dealership, if you keep doing that until you get approval, you may eventually get an approval for your car, but you're going to take such a hit on your credit because now the next person who pulls your credit is going to see that you tried 7 times to apply for something that maybe you shouldn't have been approved for. Yeah.
I think really the only real caveat to that is specifically with something like buying a vehicle, because people will shop around to see what the best deal is. So if you try, say, in the space of a weekend and you go to a few different dealerships to shop prices, it would maybe impact your credit less, but it still would negatively impact your credit.
Yeah. So how do you build your credit then? How do you improve your credit score?
Yeah, so to build your credit, once you're starting out, you have no credit score, you want to start building it, the first and easiest thing you can do is just pay your bills on time. Get your own cell phone bill, get your own power bill if you can, cable bill, and start developing a history of paying in full and on time. That being said, don't apply for things that you can't afford to pay in full and on time, because that will make things worse, which is counter to what we're trying to do. Another thing is credit cards. A lot of people advise young people to get their credit cards so that they can start building credit. And there is some truth to that, as long as you can be very diligent in using your credit card safely and not using it as an emergency fund, which we have in another video that we'll link somewhere for our thoughts on that. If you can't get approved for a credit card, you can likely get approved for a secured credit card, which is basically where you go to the bank with, $300 or $500 or something like that, and you give them the money up front, and they then give you a credit card.
And from there, you use it just like you would a regular credit
Yeah.
card. And credit cards are a good way to build credit. But again, you have to be very careful.
Very careful.
Don't spend money you don't have.
Yeah.
Pay off your credit card in full every month.
Yeah.
Another one would be loans. So if you have to take out a loan, let's say a student loan for school or a car loan, that again, it's a good way to build credit and make sure you make your payments on time, but don't take out more than you can afford. If you're buying a car and your salary is $20,000 a year, don't buy a $30,000 car. Look for a car that's like $5,000 or $7,000, a used one, and take out a small loan for that.
As a side note, a lot of people like to sort of talk down about the rich people for buying a $300,000 car. Well, yeah, that's a really expensive car that millionaire bought, but overall that car represents 3% of his yearly salary, whereas it's not uncommon for someone, say in our position, to have a car worth 100% of our yearly salary. So which seems more irresponsible, right?
Yeah. And again, not that we're encouraging you to go into debt for the sake of building credit. Again, if you can save up and buy a car cash, I would much prefer you do that. But we understand there are some circumstances where you are required to get a loan. And in which case, great, you can build your credit, but be responsible. Don't borrow more than you can afford and make your payments on time.
Yeah, just because the bank runs the numbers and says that you can afford to take out a $50,000 car loan doesn't mean you should.
Yeah, exactly.
Just because you can technically afford the payments when things are going well doesn't mean you'll be able to afford them when things aren't going well. Or it doesn't mean you can really even afford them if you like to do really selfish things like buy clothes or food.
Yes. And then the last two things here is don't apply for a bunch of credit all at the same time.
Yeah, it goes back to like we said about shopping around for cars. If you try take a bunch of loans all at once, that will negatively impact your credit score because the banks are going to look at that and say, well, geez, all of a sudden Buddy's taking out like $100,000 in small loans from 10 different institutions.
Yeah.
That looks suspicious. That is something we should look out for.
Yeah. And
finally, keep a low credit utilization. Keep your credit cards as close to paid off as you possibly can. In some instances, I've heard of people that try and improve their credit score by raising their credit limit and then never ever using it just so that they have more credit technically because they have, say, a $20,000 credit card limit, but they never take it above $1,000 or $2,000 and then they pay it off every month.
If you're disciplined enough to do that, great. But for the vast majority of people, I would probably not recommend that. I would just, stay well within your credit limit.
Yeah.
Don't raise it just for the sake of building credit unless you're incredibly disciplined and you have a proven track record of paying your credit card off in full.
A good rule of thumb with your credit limit is don't get a credit limit that you couldn't pay off in a month if you absolutely have to.
Yeah, I think that's a great way to look at it.
Even if that means you have to pay it off several times throughout the month in order to be able to afford something.
Yeah. So that's about it for this video.
Yeah, that's it for this. So hopefully you liked it. Hopefully you found some value in it. If you did like it, make sure you drop us a like, leave a comment. Subscribe if you haven't already. Sign up for notifications if you have. Ring that little bell. If you have an actual bell, ring that bad boy. And in the meantime, we'll leave you here. We'll catch you guys on the next one. We love you very much. And is it payday yet?
Bye.